Boker tov lekulam. Thank you, Avi. Thank you, Nathan. We are proud to be part of this Alony Hetz family, and we're very happy that you're a shareholder. I wanted to start differently, but the boring was a bit too heavy. So I have to tell you an anecdote. I read the program, and then I saw Sunday night, big party on the rooftop of the building. Then I said, well, I have to get prepared because Monday morning there's the presentation. I will skip the morning tour to rest because I don't know how the Israelis party, because we heard in Switzerland after 10 o'clock we have all to go home. So I got ready, went up there, I even started to dance with Avi, and at 9 o'clock Motti pulled us out of the party and we had to go to bed. So I don't know who is the boring part here, but it was a great party, great building, but that was kind of, I think Motti is more Swiss than we are, so I think that's good. I will use obviously the financial presentation we always use, which is boring. It's very numbers driven. I will give some anecdotes to it, but we try really to stick to simple numbers which analysts, investors can fill into the spreadsheets, because at the end they need to have the spreadsheets and the predictability and the credibility of the numbers. So we'll go a few key facts, few economic numbers, then go a bit to the financial results, vacancy, explain a bit the silent revolution we went through over the last 2 years, capital structure, development pipeline, and through the rest. PSP basically was born in 2000 through an IPO from an insurance company, from Zurich Financial Services. We were a 1 billion company. And today, after this almost 20 years, we are at 7.5 billion investment company. We exclusively focus on Switzerland. That's not because we are boring, but we are convinced that there's an investor community who likes the pure play, who likes a simple model, and that's what we try to deliver since years. We focus on the key markets where we see a strong, intact labor market. That's predominantly Zurich, that's Basel, that's Bern, that's Lausanne, that's Geneva. And over the years, we moved out of the secondary cities where we had assets, and we have a development pipeline of roughly 10% in asset value, but roughly 5% of additional investments we will provide in, which will generate an additional 10% top line over the next years. So that's, we clearly look at what happens in Germany, we look what happens in Italy or in France, we speak those languages, but we think we have no value add by investing in Milan, by investing in Munich. I think you as investors can do that, pick the best management of these countries, and we continue to focus on our home base. And in doing that, this is a grid not provided or developed by us, but by our valuer. You know that we're valued twice a year by an external valuer, even in the quarters, if there are major incidences on the assets. But we pretty much look at the location quality and the asset quality and try to aim to the top right. Really, for us, cash flow quality, earnings visibility is a key issue. We want to be very boring in a very boring country. We don't want to be, a growth story in a boring country. The investors look at Switzerland for stability, and we want to deliver stability. So you see on the bottom right, location quality. We are most assets bottom right in this part, and on the asset quality. Why are not all the assets on the top? We have a lot of assets which are protected by the building authority, beautiful historical assets. They will never be a top grade A building on a sustainability basis. But nevertheless, these are unique assets. And there's an example, we picked Zurich. This picture would be true for Geneva, Basel, Bern, and Lausanne. We really focus on the CBD, and Switzerland is a little country, the cities are little. The dots, you walk them in 5-10 minutes. The Bahnhofstrasse is really the one in the middle, and all the assets are really staggered around. It's a bit of luck, because the time we were born, real estate was not the flavor of the moment. UMTS was the flavor of the moment. The Swisscoms sold their assets. We were able to buy a big brewery portfolio. At that time, we were able to buy at discounts. Today, those assets go at 2% yields, if not even lower. So I think what we aim is really to take care of the assets, further develop those. But this area you see, the city is built. It's very difficult to do new developments. So there is clearly a certain scarcity value in those assets. So the strategy at this slide, Nathan and Avi have seen it since they started with us in 2006. It didn't change, but it reminds us that we want to stay focused. We want to focus on commercial assets, commercial being office, high street retail. We have also hotels in the CBD. We have elderly livings in the CBD. We have even a thermal bath. So we look at commercial activities in super prime locations. And most of the buildings are really mixed buildings, and we try to combine that with selective acquisitions. But if we buy something, we need to be able to tell a story. We need to be able to generate value over time, either through rent rolls, either through expansions, but we cannot buy just for the sake of buying. So also our incentive is towards earnings per share growth and not towards assets under management. And with that, we will see it later, we try to combine it in a very risk-conscious way and very prudent approach. If you look at the current market, we come out of a market where you see office rents coming a bit under pressure in Zurich after the financial crisis due to the bank consolidations. But we see today really a rent stabilization, even rent pickup in the CBD of Zurich and Zurich West, where focused. And you see also stabilization of the rents in Geneva. If you look at the major markets, I will tell you afterwards on the sectors, you see really there's quite a strong demand. But we are in a moderate growth environment. GDP growth in Switzerland is expected to be 1.1. Next year, perhaps 1.7. But that's the maximum we can get. We might get to a 2% GDP, but then we are operating really in full employment. And you see unemployment numbers is 2.4, 2.5%. Even more important, we have almost no unemployment at the young people, the young generation. So if you look at a couple of economic numbers and charts, you see really that Switzerland is not only financials, banks, cheese and chocolate. Zurich has evolved from being kind of a banking insurance hub also to a technology environment. You know, we attracted Google, luckily, 2006 with their international headquarters for research and development. But we have a lot of technology firms which are very close to the ETH. And that's true also for Lausanne. So basically, the Zurich and the Lausanne are more of the innovative hubs. Basel is the international center for pharmaceutical, biotech, chemical industries. You see the Roche, the Novartis, who really form a strong cluster there. Bern is the boring of the boring. It's with political capital, a very stable capital, but with also obviously very stable rents. But you have all the administrations there. And Geneva is kind of the international capital, international political and organizational hub. And you see that, those sectors, and you see that also if you look at job growth, we foresee in the major cities we are involved, a good job growth, a good population growth. As said, we are only in the commercial field, we are not in the residential field. The reason is twofold. First, the residential is very regulated in Switzerland, so it's really difficult to capture growth there. Secondly, we have a law which forbids foreign investors to own residential for investment purposes. Our shareholder base is 50% foreigners, so in that sense we are treated a bit as a foreign investor, and the reason is why we concentrate on commercial. But this is a good prospect for us. In the cities we are involved, we see job growth, we see companies moving in also in the future. And in contrast, we see limited new developments in the city center. We had this spike in Basel, these were the Roche Towers which were developed. But beside that, there's rather limited new developments in the city centers, which I think is an important matrix to add on. The rents, as I mentioned, they came down over the last 2-3 years. We see stabilization, and you see also in the office a slight pickup. First signs is reduction of incentives, obviously, and this is often then a first leeway to potential rent growth. We have 90% of our rental income is indexed to inflation. The unfortunate part, we have almost no inflation. But I think at least theoretically and technically in the models, we have an inflation linked, and if the analysts project 2% of inflation, we get something in the models. What we see in the retail, clearly also the whole shopping center retail is suffering also in Switzerland. We have 16% of our rent roll in retail, but it's purely high street retail. And I think here the interesting part is that fortunately we have in Zurich and Geneva basically one high street. We don't have the Westfield, the Brookfields, and the Bond Street and Oxford Street. We have one street. So if you own that shop, if you have Chanel in Zurich, there's one shop. So we are a bit immune to this retail dilemma. Clearly also there we have to be very diligent. What kind of surfaces here we have? Is the best use of this surface? What kind of brands we do bring in? But for us, it's rather a stabilizer in the portfolio than a risk. Two last elements is the transaction prices. Obviously here we see, as Avi mentioned, we are in a negative environment. 2015, the National Bank introduced the negative interest rates, a negative interest rate environment, and that clearly motivates institutional investors to go into yielding assets, and real estate is one of those assets. We see it predominantly in the multifamily houses. There is where the National Bank is trying to take proactive measures. In the office market, the good thing is it's domestic money, it's predominantly equity, so we are not speaking about a bubble in the sense of leverage, but clearly we see asset price inflation, and we benefited through the yield compression from it. And that shows also clearly the yields. Here, these are I would say the super prime yields. Liquidity is very low, only very few transactions. Our portfolio trades at the 3.5% yield, and our average cost of debt is 0.7, so we have quite a good margin. But clearly, if you would like to buy CBD today, you would have to pay 2%. So if you go quickly into the figures and how does this translate for PSP, we guide the market with an EBITDA number. The EBITDA number is driven predominantly by the rental income. We have seen in the first quarter quite a strong rental income growth. That was due to vacancy reduction, we'll speak later, and also thanks to acquisitions with it. And the second element is clearly the costs. There we try to be very disciplined on the cost side. But you have seen rental income 2018 at 280 million. You will see it 2019 roughly at 288, 289 million. And this allows clearly then with a very disciplined cost base. We are 90 people. We do our own property management. We do our own asset management. We have a high stability in the costs. And that translates for us in EBIT margin of plus 80%. And there's very difficult for us to imagine if we project forward and if we look at the next 5 years, we see top line growth there. We see another 10% of top line growth coming over the next 5 years. On the cost base, it's hard to imagine that we strongly deviate from, let's say, 60 million, because this is the run rate we have. It's very much under control. We have financial expenses which will further come down. We'll end of the year roughly at 20 million. The marginal cost of debt, as Nathan said, is quite low. And then we will see some benefits from the taxes. A month ago, the corporate tax reform passed in Switzerland, which was alignment of the harmonization with the OECD. And we will benefit 5 to 6 cents per share starting next year. Also on the tax side, we see a good flow, and this will help to continue this dividend path we started in 2000 with the IPO. We don't look too much on dividend yield, payout ratio. We just want to increase it every year a bit. So it's like a little mouse, 5 cents a year. We try to really have a dividend payout visibility, And for that, we need cash flow visibility, we need cost control, we need a stable organization. And we did a little bit, a stronger increase, 340 to 350 this year, as a sign of confidence that we can continue on that path. So if I look at the future of the company, it's difficult to imagine that in the next 3 to 5 years I cannot keep that path going on. Clearly that was a part of the translation in the stock price. Clearly we benefit typically when there is big uncertainties in the market. We are seen as a place to hide, as a safe haven. It's a combination of probably how we behaved in 2007. In 2007, 8, 9, we continued to increase our dividend. We were not hit by the financial crisis. And probably in this crisis now, where you have the uncertainties, the market believes that we can continue to deliver. So I would say it's not a growth story. A bit was probably re-rating of the stock, but a lot is also uncertainty of the market. If you look at the portfolio, as mentioned, we run a 7.7 billion portfolio. Vacancy came down significantly over the last 2 years. We were historically at the vacancy rate of 10, 11, 12%. On the one hand, for good reasons, we bought 2004 a large portfolio in Zurich West on the west end, which was an industrial area. And we always said we will one day develop it, one day the vacancy rate come down. But somehow the market started, I guess, not to believe in it. And what we did, Adrian, Martin, myself, when we took over 2 years ago, we undertook a little, I would call it a silent revolution. We didn't want to say that we bring down the vacancy, but we wanted to demonstrate it. And basically goes in line what Oli said at Car Properties. We repositioned the company as a client-centric organization. We were always very close to the capital market, but we lost a bit ground on the tenant market, on the real estate market, on the trend market. So we had to change a few people. We had to get closer to our customers. We introduced key accounting. We repositioned our assets, that when tenants come to us, they see the future of a workplace and not a bureaucratic building. And we really tried to bring people in front of tenants. Historically, we were afraid to get the bad news and then had surprises of the bad news. Today, we want to know which tenant is growing, what does he need, if he needs less space, how can we help? And to be also a bit more proactive in trends. We'll speak later. We believe in flex space, but more in the flexibility need of tenants. So the concept of having mixed-use building with a buffer in it is a concept we believe in it. We don't believe yet in the fact that we need to operate it. So we treat flex space providers as a tenant, as a customer, as a client, perhaps also because the Swiss market is a very small market, and depending on where you are, you need a different provider. We have, for instance, in the Zurich West area, we have a very innovative co-working provider, which is called West Hive, which is a kind of a community builder. He attracts incubators. You couldn't use him in the Bahnhofstrasse. In Bahnhofstrasse, we have a high-end serviced office provider, which attracts family offices. And if we would build this up, we probably at the moment couldn't match all those needs. It would implode. So for the moment, we try to engage, to learn, and we think as landlord, we don't lose the first mover advantage. If we see that the office becomes a hospitality business, we're still the owner of the building, and as long as we take care of owning the best buildings, the best spots, we can always catch up on that side. But that's a bit the philosophy. We need to be close to the market. We need to see transactions. We did acquisitions. We sold some assets. So we're going also a bit more in a portfolio rotation just to move up our quality to further improve the cash flow quality. That was a bit the mindset and the motivational shift. Clearly, we also put in a fitness center in our building. We put in a big kitchen so the people cook with a lake view. The building is not so nice from the outside, but inside very modern to really testify this new working environment. Clearly, as I mentioned, we are in a world of yield compression. Also, our yields came down over the last years, clearly driving up the values. If you look now, we are at the average yield of 3.5. If we look at the transactional market at the moment, I wouldn't be surprised if we see further little minor yield compression. That's what we said also Q1 in the market. Our valuer very looks at transactional evidence. There is some transactional evidence. We don't have the read across you see in the US or in London, where then you have a read across through all the assets. But the valuer might really here and there have to further reduce a bit the yields. On the capital structure, I take this slide. We run at a loan to value of 30-35%. We run at average cost of debt passing of 0.8%. And we try continuously to optimize our balance sheet. We see the asset side, we have to improve the earnings, and on the passive side, we have to improve our costs. We have 2 ratings from Moody's and Fitch. We are the only company in Switzerland who has ratings from the international organizations. And this allows us really to tap into the capital market and take advantage of this perceived quality. As mentioned, we did 0 coupon bonds, which is per se not healthy, which demonstrates the dramatic situation on the capital markets, but we try to take advantage of it. And clearly we operate at an ICR of 12, 13. Equity ratio covenants are at 40%, so we are way out in the comfort zone. But we don't want to put that at risk. Whenever we look at transactions, I say it anecdotally, everything is accretive if we would buy, because we could fund negatively. So we have to be very disciplined on how we cope and how we invest our money. On development projects, we are a listed company, and in the listed world, the development projects are well seen, but very closely monitored, and you always have to find a balance on how much you're involved. Investors typically don't like too much of development. I would say wrongly so, but it's a listed vehicle. Rating agencies are very scary about it, so you have to find a good way. We will invest roughly 300 million in the next few years. We have a second pipeline lined up in the portfolio, but it's very difficult for us to go out and to buy land and to develop from scratch because the city centers are built. So we are rather orientated towards optimizing of the portfolio. A few examples, or here as a summary, you see that, and why I'm saying that 10% top line growth comes is because all those projects are pretty much pre-let. And these are excellent tenants which come in, so we have a very good visibility on the earnings growth for the next year. A few examples. The most prominent one, if you go into YouTube and you put in Bahnhofplatz 1, you see a big fire. This is a historical building really opposite the main station of Zurich, where we had a fire back in August. We don't know yet the causes of that fire, but it pushed back the whole renovation site and construction development by 1.5 years. Luckily, we have a good building insurance, we have a good site insurance, and we have a good business interruption insurance. So we will be paid starting end of this year for a building which is empty for 1.5 years. So we have no loss on the rental income. Clearly, we have a big hassle in going through the whole cleanup and redevelopment and building permission part. It's a big focus of the organization, but we have no negative impact financially. And we have asked the valuer shortly after the fire to value that building, and there was no valuation loss on that building, obviously because the lack of, or the missing of the rental income was covered by the insurance company. And at the end, we should have even a more efficient building, which the next generation will benefit because we have already a lease agreement. But I think this is positive. We own the whole plot. On the back end, this was a former cinema. We will have a luxury hotel, Ruby Hotel Resorts coming in, and we have a brasserie, so the whole complex. And the front side will be number 18, which is the premium brand of the IVG group. So it will be a complex with flex space, hotel, and brasserie in front of the main station of Zurich. Something completely different is the last residential development we do. We have, as I mentioned, bought a big brewery portfolio back in 2004-05, and out of that we did mixed-use developments. This is a development on the lake shore of Lugano, roughly 110 apartments. It took us 15 years to get the building permission, and we went 2 times to the federal court, only because a neighbor wanted to have 4 garages for free, and we said we don't give in. Luckily, the market always improved, so we are very positive that this will be a very nice project. It's a one-off gain, and we here estimate yield on costs of 25-30% on such a project. And then if you go on the one in Geneva, that's a conversion project. Rue du Marché is next to Rue du Rhône on the lake, former office building, which we are converting. We have ground floor high street retail, fully let. And then we have a conversion into a hotel. It will be a Citizen M Group, which is originally owned by the Dutch pension fund APG, and now they have GIC as a shareholder. This is a highly digitalized, efficient hotel concept, which was fitting perfectly in that building. So behind every window you have a room. Room sizes are very small, no reception area, kind of a co-working lobby area, but they're able to pay higher rents than office rents, and justifies really our investment in that concept. And last but not least, this is the Zurich West area. All the white buildings are buildings we own in Zurich West. Here we tear down 2 buildings. After that, the stock exchange moved their headquarters into Zurich West. After University of Arts built their headquarters there. And we are building here a new 20,000 square meter building. We have secured a very innovative shoe brand, which is called On Shoes, apparently also available in a store here in Tel Aviv. And they will put in their headquarters in. We will have conferencing, we will have flex space, and the whole area there is really rejuvenating. It was a light industrial area. I think the only thing, the mistake we did, it took much longer. This is really city development, but it goes really in the right direction. Then we did 2 acquisitions early this year in the Bern, close to the Parliament, and we did some disposals. One of them at a very high premium to book value. I wouldn't say that's a read across now for the portfolio. It was also a very unique buyer, but that gives an indication we want to really try to continuously optimize the portfolio. Subsequent events, we had the AGM. Our friends Avi and Nathan were re-elected. Very stable also from that end. If you look here, our board of directors, 7 members, long-lasting, and an executive board of 3 persons. If you go quickly on the outlook, we guided for the year an EBITDA of 250 million. We improved our vacancy rate guidance to 4.5%. And as a summary, why do we think somebody should invest or be invested in PSP? It allows an investment in a premium portfolio. It's very difficult to get commercial exposure in Switzerland. So for an institutional investor, it allows to get exposure in a premium area. We think with a relative basis, limited downside risk. It's inflation linked. We try really, on what Nathan said, to be very, very transparent. So you should, if you read our annual report, you know the company. If you like it, you buy the stock. If you don't like it, you sell it. The day you want to like it, shouldn't see surprises. We want that you have a continuity in what you read, and that we can prove quarter by quarter on what we promised. We are a pure Swiss play, and clearly we continue to optimize. And here, getting the organization ready for whatever might happen. Clearly, we have the ambition to grow, but we have to grow with the aim to create shareholder value. And you want to have an organization ready to do that. Perhaps 2 words on the shareholder base. We have, as I mentioned at the beginning, for a Swiss company, we have a very international shareholder base. 50% of our investors are foreign investors. Beside Alony Hetz, we have the typical Dutch pension funds. US fund managers out of the UK, so it's a very international base. And perhaps 2 words on co-working, which we heard before from Oliver. This is a sharp line going up on a very small level. These are the number of co-working space in Switzerland. Clearly we see a trend, but we don't see this tremendous trend you see in London, in New York, in Paris, due to the fact that we have also small buildings. And for the big co-working providers, it's really difficult to get size. Additionally, we have the Swiss companies who like to have their own offices. So I think it's a trend we see. We are at the forefront. We have 9 relationships with different providers, but it's not there yet where you see the trends in other cities. And it's often concentrated in the major cities, in small, medium-sized centers, but it's really just creeping up. And if you look at a broader map, this is Switzerland in the context of the south part Italy, west side France, north side Germany. It's staggered around where our locations and buildings are. It's Zurich, it's Basel, it's Bern, it's Geneva, it's Lausanne. With that, I would say a few minutes ahead. I thank you for your attention and I wish you a nice day. Thank you.